This first chart that I'm showing you is a chart that outperforms the S&P 500 over the last 5 years. This chart that I'm showing you shows an outperformance versus two of the top market darlings, Apple and Microsoft, over the last 5 years. Now, what is this company in blue? This blue line that's outperforming both the index as well as two of the top companies in the entire planet? It's Crocs. It's not some major high-name growth tech company that you've never heard of, or some semiconductor company that came up out of the blue like Nvidia or something like that. It is Crocs, the boring, everyday shoe brand that we all know and love and have come to wear in our household and even sometimes in the workplace on a daily basis. It's companies like these that outperform the market but never get the attention. If we hop over to M1 Finance here and we go over to the research tab and we type in ticker symbol CROX for Croc stock, and you look over the last 5 years, this company's performance, despite its downturn, is still up 686% over the last 5 years. And over the last 5 years, as you can see from this chart right here, it has grown over the last 5 years at a compounded annual growth rate of 49% in terms of its stock price. And so that leads me to the question. Crocs, it's a company that you would never think of as an investment. And is this company going to continue to have its excellent, superior performance that it's had over the last 5 years? Well, that's what we're going to answer in today's episode. Now, big spoiler alert, if you didn't know already, like I say every single video, I showcase my portfolio balance as well as my portfolio holdings every single month, every single day, on every single video, and I am a shareholder of Crocs. So go into this video aware that I will have a biased opinion on this company. As of today, we have about a $40,000 account balance, and this is our performance year to date and since joining this brokerage. Now, with owning Croc stock, I also have portfolios that I showcase, including my other 3 companies in the growth stocks, which are shown right here through M1 Finance, which is shared down below in the description via referral link, as you can see, which is right here. And if you want to get signed up with M1 Finance, you'd help support me in the channel and get $10 for doing so. But that's not why you're here. You're here to see Crocs and why this company has had fantastic growth in not only share price, but as a company as well. So thank you for tuning in. If you find this video helpful and provide some insight to a company you normally wouldn't think about, you would never think about investing in, subscribe and help support me in the channel. So without further ado, let's go ahead and dive into Croc stock. Let's go ahead and look on the last couple of quarters here, and let's look at this company's revenue. Let's go ahead and zoom in so we can get the chart nice and big here. Previously, for the past several years, all the way from about 2011 all the way through about 2019, this company hovered at the same quarterly revenue at around 250 to 300 million. And then when the pandemic hit, something happened. This company began to take off from 300 million to 400 million. And to now most recent quarter, we are now almost $1 billion in revenue on a per quarter basis. And this is expected to grow. And so I wouldn't be surprised if next quarter we break $1 billion. What about profitability? Well, this is especially apparent when you put this on an annual basis. This company really hovered around flat profits for really once again for the last decade or so until we got to 2020 when this became a pandemic play, when the free cash flow went from about 50 to 100 million up to 200 million, and then last year's most recent $500 million. This even becomes more apparent when we switch it to free cash flow per share, which factors in share accretion as the company has bought back a lot of its own stock. And if you want to see that, you can see that from its quarterly chart right here. As this company has continually bought back stock since about 2014, it has bought it back over and over and over again, going down to about 60 million in shares outstanding now. Now that's great. You see that this company's grown a lot. You see that it's had great revenue, it's had great profitability, but what has come from that? Well, the main reason is because of this company's growth in both its traditional old school Crocs brand, but its big acquisition that it just made and closed on here in 2022. On this article titled Growth, it says one of the primary factors driving the investment thesis on Crocs is steady but rapid growth from their classic clogs paired with stunning growth from their Hey Dude brand. In quarter 2 of 2022, their most recent reporting, they grew 14% on the Crocs band. 19% on a constant currency. If you don't know what that means, as we get a stronger dollar, foreign revenues are worth less. So if we didn't have the dollar go up so much in value, we actually would have grown 19% in their old school Crocs brand, the brand that's been around for decades, which was 732 million in quarter 2. This phenomenal growth in the past year was reaffirmed with strong guidance outlook of 17% growth looking into the future. Additionally, they boasted 21% digital sales, 36% digital sales penetration, and rapidly grew their revenues in 4 markets markets with 17% in Asia. Now, we could keep going on Crocs, and that's great. You see at this revenue chart as it's gone up over time, a lot of it has come from its traditional Crocs brand, but they just closed on a big deal just about 6 months ago. And that leads me to the next tab here, which is Hey Dude. We talked about Crocs and how they grew 14%, which was 19 on a constant currency basis, and 14 and 19% growth is really good, but you want to know what's better than 14 and 19% growth? As of the most recent quarter, from this sentence right here, in quarter 2 of 2022, the brand Hey Dude grew 96% year over year. The company Hey Dude, the Hey Dude shoes that you all know and love, or maybe you don't know, we'll go ahead and take a look. In case you're not familiar, this is what Hey Dude shoes look like. They have both a male and female version, and literally as I'm speaking, I'm wearing Hey Dudes right now. I believe this is the actual pair I'm wearing on my feet, yeah, right now as we speak. And I love these. They're so comfortable, and just this past week, I had both my boss and my brother-in-law ask what type of shoes they were because they liked them and they wanted to buy them, and they've been seeing people wear them. So I think that this 96% growth that we're seeing right here is not going to stop. I think that this company is just getting started, and furthermore, it's not just a revenue story, it's a profitability story as well, because this company is projecting 26% plus operating margins going into the future. Now, this is a little snapshot of the transaction from them purchasing Hey Dudes. Now, if you go over here to Qualtrim, there's one thing that I hate. So real quick, we're talking a lot about positives. This is one of the big risks of the company. So if you're listening to this and you're thinking, wow, Jordan, this all sounds great. I've never thought about Crocs as a potential investment. What's the holdup? Why is this company trading so low? Why over the last year, hopping back to the research tab here, why over the last year has this company's share price went down so much, and the last year being down 44% and year to date being down 40% as well? What's caused that? Well, the big issue and the only main reason why I don't like this company and why it's not a huge position of mine is the debt. Now, you might be seeing this huge spike up. This company really ran at little to no debt until 2022. They had a couple $100 million, which is relative to this company's size is not very big at all, not a big deal, and they always had plenty of cash to pay that off for a long time, hundreds of million on the balance sheet, so that was never a problem. Until you had the first quarter of 2022, when this company tacked on $2 billion plus in long-term debt, seemingly out of nowhere. And where did that come from? Well, it's from that Hey Dude acquisition. $2 billion, as you can see right here, came from the funding that they raised in long-term debt to buy this company. Now, this will obviously increase revenues and profitability, so this debt in the long term will be coming down, and this is the one big short-term risk. If for whatever reason we were to have some immediate horrible recession or even depression, a company like Crocs could really be in trouble as it has a huge amount of debt on the balance sheet, especially relative to its cash, only having $187 million as of last quarter. But if we compare this to the cash and debt, while it might look really scary seeing this big red line up here, notice how in the last quarter it's already reduced hundreds of millions of dollars. And that has become apparent in my belief that they will pay off this debt fast because they have made a promise to shareholders that right here, no share repurchases in 2022 until gross leverage is under 2x. And this company previously was spending millions and millions and billions of dollars on share buybacks, buying back a huge percent of this company's shares back, about 20% just over the last 3 or 4 years or so. You can see the millions of shares going down each and every quarter, and that's coming to a stop until they can get this debt under control. So here's the cool part. Right now you have this big, scary, looming debt over the company right now, but this is going to quickly evaporate. It's going to go from 2.8 billion down to 2.6, down to 2.5, down to 2, down to 1.5, and eventually this debt is not going to be very big of a problem anymore, and they're going to have record revenues like they already have from their huge growth, and likely they're going to have sky-high profitability and free cash flow like the $136 million of free cash flow they put up last quarter. Now, how's this company Hey Dudes doing as a company? Now, this is over the last 5 years, and so this company has really come up in the last couple of years in terms of its popularity, and you can see that it's generally on a growth trend up. Going back to 2017 when the search trends were basically zero, slowly as we go through over time, you can see that it's gradually growing, and you see two major spikes up, which is November of 2020 and then November of 2021. Now, right now we're in October, and we're pretty close to where we were last year, so I'm really interested to see where the holidays come out for Hey Dudes in terms of the Christmas shopping and more importantly Black Friday, as people try to buy these for brothers, for boyfriends, for fathers, sons, all types of things like that. And then of course women as well, who are also big wearers of these types of shoes. Now, the actual Crocs brand itself. I looked over the last 3 years. Now here's why I pulled up 3 years over 5 years, is because this company really exploded during the pandemic, which factors in the big boom in 2020, which is March of 2020 right here, which was peak search trends, around 96 out of 100. Now where are we at now? You see that over the last couple months we floated around 60, 70, even hitting 80s at some point. But as of right now, the search trends are coming in at 88. And this is not some major holiday. This is the middle of October. This is not some big Black Friday event or some Christmas shopping sale. This is just a regular time of the year, and it's at max search trends, almost to its all-time high. And that's for its traditional Crocs brand. And when you also have Hey Dude growing at 96% year over year, I think that this is shaping up to be a company that's going to blow its estimates out of the water. So when you look at this company's valuation, let's look at this company's free cash flows last year. This company had free cash flow of $500 million, $500 million to be exact. And so when you look at this company's free cash flow yield, it's currently trading at 6.7% free cash flow yield. It's a $4 billion company putting up $500 million in free cash flow. That is less than a 10x. That's about a 9.5x its free cash flow versus last year, which it's likely to exceed that this year, especially as it uses it in a more smart of accretive way. Its PE ratio, it's trailing trails at an 8, its forward trails at a 7. It's not very often you see a company trade at a low valuation such as this while having 686% returns over the last 5 years. So while it's very easy to look at all this stuff that I'm showing you and say, okay, it did happen to outperform Microsoft, it did happen to outperform Apple, it did beat the overall market, it beat the S&P 500 over the last 5 years. And this company may be a flop. I could be completely wrong. And this is one that I'm not as confident as some of my many confident holdings like Amazon or Salesforce or Google, my other 3 companies I own, as the likelihood of me making money in these companies are almost a certainty. Crocs is a little bit of a wild card. It's not one that people typically think of when they think of as a smart investment. But I have to be honest, while it is my smallest out of 4 investments right now in my growth portfolio, I'm considering doubling down on my position. Because when I look at these search trends continually hitting sky high levels and trending upwards, and I see that debt going downwards and this company trading at rock bottom valuations, it really gets me excited for what we're going to do in the future, and it makes me think that this company's share price is bound to explode over the next year or two as we prove the concept of buying out Hey Dudes as a real long-term growing brand. Now, thank you guys so much for watching. Check out all the stuff down below in the description if you didn't already, and get signed up with M1 Finance to help support me and the channel. But thank you guys so much for watching. Subscribe if you haven't already, and I'll catch you guys next time.